I'm doing some tax analysis for a 63-year-old client named Jay down in Florida. And Jay's concern is making his Social Security become taxable. So we're trying to determine how much money can we withdraw from either a traditional IRA or 401k, or maybe even a taxable annuity. And I was sharing with Jay that just because your Social Security becomes taxable doesn't mean that you're actually going to owe or pay any tax at all. And what I'm specifically working on for this situation is this non-qualified annuity. I didn't sell him this product, but he put 280 in with an advisor from previous long ago, and now it's worth 420. And the taxable income, and notice I say income, not gains, because this is taxed as ordinary income, and it's taxed on the gains first. And what I don't love about the non-qualified annuity is that even from an estate planning perspective, the gains are still going to be taxable to the kids. The product has a lot of bells and whistles that are pretty expensive, and what I want to do is allow his other money to continue to grow while we try to live off of this and basically spend this money first in the most tax efficient way possible. And of course, the first concern here was making Social Security taxable. But I'm going to show here in this example where yes, the Social Security becomes taxable, but you still end up paying zero in taxes. I'm going to give you the short version, but if you're going to try to determine if Social Security is taxable, I'm going to recommend you to check out publication 915. In order to determine the taxability of Social Security, we have to find what's called provisional income. In order to do that, you basically take the adjusted gross income, which in this case, the income is going to be from the annuity, $36,000, and half of the Social Security benefit, giving us a total of $53,400. And from here, you have to reference this little chart that determines how much of the Social Security is going to be taxable. In a lot of cases, if you're over $44,000 married filing jointly, 85% of Social Security is going to be taxable. And of course, this calculation is not just 85% of the provisional income. There's an entire worksheet that you have to go through to determine how much is over the $44,000 threshold, and if half the Social Security benefit is greater or less than $6,000. I highly recommend you use some tax planning software or closely monitor some ChatGPT analysis here. And what we finally determined is the taxable Social Security being $13,990. So I'm just going to round the taxable Social Security to $14,000, add that to the income from the annuity, and we're looking at AGI, adjusted gross income, of $50,000. Once we know that the gross income is $50,000, we can subtract the standard deduction in 2026 at married filing jointly $32,200, giving you taxable income of $17,800. Then we can look up our married filing jointly tax bracket that the first $24,800 is taxed at 10%. So we're going to take 10% of the taxable income, showing that we owe $1,780 in taxes. However, if you notice carefully, we have two kids that are dependents, and you get a child credit. And the $2,000 credit actually completely wipes out whatever amount is owed here. And there's actually a potential refund above and beyond. Now, this refund is actually for the child tax credit only available as a percentage of any earned income you have. And unfortunately, annuity withdrawals are not earned income, even though it's taxed as ordinary income. But just kind of a side note for potentially any other lower income earning families out there, that you could actually file a tax return and maybe get money back. And instead of owing taxes, Uncle Sam's actually paying you. So of course, none of this is advice, but just wanted to share the difference here that yes, the Social Security did indeed become taxable, but the client ended up paying zero in taxes.